In the last video, we understood why it is not very important for us to predict whether a stock is going to go up or down. And we understood the importance of taking precautions when you invest, and how to understand whether a stock is a good stock or not, and how do you decide when to buy and when to sell. And I promised that we would start a series of videos in which we would take up one stock, analyze it on a fundamental level, and then do a technical analysis to to identify at what price would a long-term investor get in on that stock. What would be a good price for a swing trader, and how would a intraday trader analyze the stock for entry and exit. So the stock that we are going to look today is Apollo Hospital. So let's go to screener. Now, Screener is a website that I usually go to because it's a very simple website, very very clean, doesn't have any ads or any clutter, and shows all the fundamentals very beautifully. So Apollo Hospital. All right. Apollo Hospital was established in 1983 by Dr. Pratap Reddy. I'm not going to read through all the details of the hospital because we know what it does. It's basically a hospital company. It's basically redefined modern healthcare in India. Nation's first corporate hospital. It's acclaimed for pioneering the private healthcare revolution in India. So um, it's emerged as Asia's foremost integrated healthcare services provider and has a robust presence across the healthcare ecosystems, including hospitals and pharmacies. So essentially, it's a very, very good hospital. It's got some very innovative ways of providing healthcare, and it's emerging as one of the best hospital companies in all of Asia, not just in India. There's the market cap and some other details. I usually don't go into it that much. The chart we will look at a little bit later. There are a few pros and cons that Screener provides. I just quickly take a look at it. I don't completely rely on it, but it's a good view at what Screener thinks. So pros, our company has been maintaining a healthy dividend payout of 37.66%, which is good. And the company's median sales growth is 17.72% of last 10 years, which is excellent. It's maintained a good sales growth. The cons are that the stock is very expensive at this point, primarily, and the promoter holding has decreased by 1% in the last quarter, and we'll take a look at why that has happened and what's happened. Company has a low return of equity, it says, and the promoters have pledged 27.94% of the holding. What that essentially means is that the promoters of the company who are holding the shares of the company have taken a loan on their shares. So they have pledged their shares to borrow money from the market, which is usually not a very good sign. Yeah? Now, other things. If we compare them with its peers, um, it's the leading hospital company among all its peers because of its market cap. So in market cap, it's leading. There are a few other parameters. It takes the current market price of the stock and so on and so forth, a number of other things. But the important thing here is that it's leading as far as the market cap is concerned. Let's take a look at the profit and loss of the company. These are quarterly results. You could look at that, but let's take a higher level look because we're trying to understand how strong the company is. If you look at the sales, which is the top line of the company, it was 1,614 crores in 2009. It has consistently kept on increasing over a period of time, even in March 2020. And it has never essentially gone down. The bottom line is the profit after tax, which is basically the net profit here. Sorry. So it was 102 crores in 2009, and it has consistently kept on increasing and is 455 crores in March 2020, which is a good sign. We don't look at these numbers in isolation. We look at them as a pattern. So how is it growing? Is it growing consistently? Is it going up and down? Is it falling, etc., etc.? Now, we see that there was a dip here in 2018 and probably a dip here in 2017 as well, but it's covered up quite well at this point. If you look at the balance sheet, the important numbers that I usually look at in a balance sheet are the liabilities and the assets. So here the total liabilities, they have increased over a period of time. Now, just because the liabilities have increased, which is, I should be looking at the other liabilities section here, they have increased. If you look at the assets have increased at a far greater rate than the liabilities. So the difference between the liabilities and assets have been maintained quite in a very healthy way. So that is a good sign basically. Yeah. The cash flows have been good. The cash from operating activity has over a period of time increased. Um, Cash from financing activity has over a period of time decreased and is now in negative, which is a good thing. There are other ratios like return on capital. Return on capital is also, sort of, well, a little bit down from 16 to 19, but is covering up in 2020, which is a good sign. The inventory turnover has also remained stable, which is a good thing. Debtor days, the lesser they are, the better it is. What debtor days means is that how quickly is the company able to return the money to its debtors. And the debtor days have been maintained from 39. They increased a little bit here from up to 45 and 46, but then it started falling from 2014 and is continuously reducing, which is a healthy sign. Finally, we come to the shareholder pattern. One more thing which we should look at is corporate actions. Corporate actions essentially is the dividend and the bonuses that the company gives out and the splits and etc. What are the corporate activities that it does? Now, if you look at this, since 2005, it's been giving out dividends on a regular basis every single year, sometimes twice a year. If you look at 2007 or 2020, it's given an interim dividend as well, which is a very healthy sign. It gives out dividends. Not only that, in 2010 it also gave out a split, and it was a one-on-one split, I believe. The new face value, basically went half, which means it's a one-on-one split. And it's been 10 years now, so there's a high probability that it might declare another split anytime. It could. I'm not saying it will. It could, which is usually, a good sign. Um, so the company overall looks healthy. Now, let's look at the shareholding pattern. The promoters were at a 34.4%, and they maintained a 34.4% till 2019. And then um, the pattern reduced to 30.82%, and now it's gone down to 29.8%. Now, the thing is that if this share holding would have gone from the promoters to the public, it would have been a very bad thing. What it would have meant is that the promoters of the company are not finding a very healthy future of the company. They don't think that the company is going to grow or give them return. So they're selling off the stocks, and the stocks are basically going to the public. But there's another cause because of which the promoter holding pattern could reduce, and that is that the FIIs and the DIIs are buying them off. Right? So if you look at here, the FIIs were at a 48% shareholding. 48% of the shares were held by foreign institutional investors, which fell a little bit initially, but then it rose again to 48, and then it fell a little bit, and then it rose again to 51, and now is at 54, which essentially means that the foreign institutional investors think that Apollo Hospital has a bright future, and then they're buying off those stocks. They're picking those stocks up, some from the public, but some from the promoters as well. So if you look at the public, the 8.55% of the total stocks were with the public. Now it went up and down a little bit, but now it is consistently falling for the last many years. From 7.25, it went to 6.43, and then 6.4, and now at 6.2, which means that foreign institutional investors are buying off the public. If you look at the DIIs, it was at 8.35%. It went up to 13, fell a little bit, and then is now at 9.25%, which is essentially more than what it was at 2018. It's gone up and down a little bit, but they are also trying to maintain a healthy portion of the total stocks of the company. So even though the con is that the shareholding pattern has gone down a little bit, promoters have reduced their share. Um, the good thing is that those shares have been picked up by FIIs and DIIs. So fundamentally, I think this is a good company and it's definitely worth investing into it. It's not going away anywhere soon. Healthcare is a beautiful product, and Apollo Hospitals is quite innovative in the way that they provide their healthcare services. So let's look at what price you would want to get in if you are a long-term investor, um, medium-term intraday, or medium-term trader, or an intraday trader. But before we can get into the technical analysis of the intraday and the swing trader, let's take a look at the technical analysis from a long-term perspective. What you see on this chart is Apollo Hospitals, and this is a monthly chart of Apollo Hospitals. Uh, it went public in 2008, and as you can see, since 2008, it has constantly given a decent and very good growth. The only big dip that we see here is about June 2020, probably April 2020, March and April 2020, where we see a big red candle, and then it quickly recovered and has consistently given us good growth. Now, obviously, um, these times are COVID-19 times, so healthcare companies usually are not that much affected by this, by the slump. But Apollo Hospitals overall in the last 20 years has given a very good growth. Now, let's say that I'm a long-term investor and I would like to invest in Apollo Hospitals. How would I go about it? So I would take a look at first the weekly chart. The weekly chart is a weekly candlestick chart where every candlestick represents 1 week. So this week, this red candle that you see is this week that's going on. This is the previous week and the week before, and so on. And it shows that the week opened at a high note this week and closed at a low note. So, and that's why it's colored as red. So if I were to invest, I would need to find out what would be a good price to buy. Um, um, So what I would do is I would identify a basing candle from where there was a jump in the price. And once the price returns to that particular price, I would probably enter. So on the weekly chart, I can see that there's this basing candle, and I'm drawing a demand zone here. And what I would do is I would go to the daily chart from here, and I would take a look at whether we are close enough for that. Now, let's see if I can delete all indicators here. Now, here I see that there's another basing candle in the daily chart over here, uh, from where there was a big jump and then a second jump. So I think somewhere in between 2970, which is a demand zone on the weekly chart, and 3015, which is a demand zone in the daily chart, I think it would be a good idea for me to enter. So I would take my entry and I would enter somewhere in between both of these. So a decent price for me to enter would be 2991. Now, if you notice, there are a couple of other indicators which are also there on my chart, which guide me and help me understand whether it's a good price or not. Now, previously I talked about, we buy cheap and sell dear. The question is, how do we know whether the price that we see is cheap or expensive? Just because the price is 3,000 rupees or 30,000 rupees for a stock doesn't mean it's expensive. Just because it is 20 rupees or even 2 rupees doesn't mean it's cheap. Uh, so one indicator is the relative strength index. What it means is it basically calculates based on historical data and sees that this price, it's ranged between a high and a low. And it basically gives us a rough estimate on what price for this particular stock is a low price and a high price. So I'm using this indicator. This is called the relative strength index. And as you can see, the red line is slowly going down, which means that the supply is more and the demand is less, and the strength it's losing strength and it's getting cheaper by the day. At this point in time, the relative strength index is showing 51.89. What that means is it's in the middle somewhere. So I wouldn't buy immediately. I would let it fall. Once the price falls down to 2991.25, at that time, the relative strength index would also be low enough for me. And the final indicator that I would look at is the Bollinger Bands. At this point, the Bollinger Band is not being touched. The concept is once the Bollinger Band is touched or breached, the price usually springs back to the mean, which is to the center of the Bollinger Band. So by the time it reaches 2991, it would have touched or even breached the lower Bollinger Band, and then it would be ready for an upward move. And that's how we sort of try to understand, as a long-term investor, what would be a good price for me to buy. Now, this is Apollo Hospitals is a little bit tricky for the long-term investor, because if you look at the weekly chart, it's consistently been going up and up. There was a demand zone here, which from where the price went up, and then it came down and touched the demand zone. And then I can see that the price went up and then came down here a little bit. So I see there's a small basing kettle here as well. So it's a little bit tricky on the weekly chart. Ideally, I would want it to come down till 2970 or perhaps even lower than 2970. But since this is a trend, this is a stock that's been rallying for a while now, we may not get that price. So, it would be a good idea to take it at the price that we decided, and that's between the weekly demand zone and the daily demand zone. Yeah. So let's take a look at what it would, if I were a swing trader, what price would I get into? Let me delete all these demand zones and supply zones, and let me go into a lower time frame. What that would mean is I would go into a 60-minute chart, because if I am a swing trader, I'm looking for returns within the next couple of days to weeks, probably early to next week. Yeah. So here I would look at 60-minute chart, because I'm not really investing for the long term. And I would see at what price it is. So I see that it is at 3149. I would try to look for a demand zone which is slightly lower than 3149. The price is already coming down. It's already touched the lower Bollinger Band, which means it's already cheap for me. And there's a chance that it might go up from here a little bit. Now you would ask me, if the price is going to go up from 3149, why can't a long-term investor buy at this price? The answer lies in the amount of profit that the long-term investor is expecting and the amount of profit that the short-term investor is expecting. Now, if I am looking for returns in the next couple of days to weeks, I'm expecting a return of about 8 to 10%, not more than that. But a long-term investor would expect a multi-bagger. He would expect the price to double over a period of time. Now, the price is not going to double in the next couple of days. It may give us a jump. It may go up 5-10%, and then from there it would correct again, come down again, then jump again, go up 5 to 10%, then correct again, and so on. And that's how the stock progresses. So swing trader, what he expects to do is every time it jumps up 10%, he would sell, get his returns, and then again when it corrects, he would again get in, and then so on. A long-term investor doesn't look at the price that way. He doesn't try to get his money back within the next couple of days in 5 to 10%. He's not interested in that. It's a different personality, that's all. So as a swing trader, I would probably buy at 3140 because I see that it's already corrected. The RSI at 60 minutes is actually quite low. It's at 40 already. It goes down a little bit. It would probably touch 35. It's already breached the Bollinger Band. I could wait a little bit more perhaps, but I think that there's a good possibility that the price will turn from here and go up till this supply zone that I see here. There's a small basing candle here from where I see there was a sharp red candle, and then it can continue to drop down, and it's still dropping. So as a swing trader, my buy price would be 3140. Now, the question is, what would I do if I were an intraday? Now, I think you would already understand. If I were an intraday player, I would go on a lower time frame chart. Now, let me just delete all the demand zones and supply zones here so that there's no confusion. And go to lower time frame, which would be 15 minutes. So intraday players usually play in the time frame of 15 minutes. 5 minutes to 15 minutes. Okay, so let's see. I'll go to 15 minutes. I'm not myself an intraday trader, but the concept is not very different from um, swing and such. So this is my 15-minute chart. If you see the price has been dropping, let's take a look. Let's zoom out a little bit and see if we have a demand zone anywhere. Okay, so the demand zone I think would not be very different from what we already saw on the 60-minute chart. Let's see if I can identify a demand zone here and a supply zone here. There you go. So I can see that there is a demand zone here at 3137, and the price is actually quite close to 3137. And I see that there's a strong supply zone here at about 3210. So, and if you look at the DATR is the daily average trading range. It's about 72 rupees. So there's a good chance that, the price will range between these two demand zones and supply zones. The Bollinger Band has been breached. Like every time the Bollinger Band is breached, the price brings back up. Well, most of the times. So I see that it's, breached here. I would enter at 3137 with the stop loss at 3123, and I would expect the target to be 3210. That's what I would do as a intraday trader. Once you understand this, you'll realize that it really doesn't matter whether the price is going to go up in the future or go down. One is, it is impossible to predict to the 100% accuracy whether the price is going to go up or down. Second is, if it goes down, I buy. If it goes up, I sell. If it goes beyond what I buy, as in if it goes below what I buy, and if it hits my stop loss, I get out and I don't feel bad about it, because if I'm buying cheap, the probability of it going and hitting my stop loss is lower than it going up. Um, so what that means is majority of the times my stop loss will not be hit, and it will go upwards. In intraday, we have very little time, so there is a probability that we may not hit our target, but there's a higher probability that we'll end up making a profit. That's all I have for you today, folks. I hope you enjoyed the content. Um, do let me know if you have any feedback. I'm always looking to learn new things. Um, Other than that, I wish us all the best, and I hope we make a ton of money off the stock markets. Have fun.